The Principles of Economics with Applications to Practical Problems by Albert Fetter. Chapter 16. Interest on Money Loans. Section 1. Various forms of contract interest. Number 1. Interest, the amount paid according to contract by one person to another for credit given in terms of money, is but one expression of a larger problem, that of a difference in present worth of goods at two periods of time. This larger problem appears under several forms. First, as a difference in value due to time, where there is no money expression, to be considered in the following chapter. Second, in discount on a money loan for a short, definite time. Third, in a long time money loan at a fixed rate of interest. Fourth, in a credit loan, that is, the sale of the thing on credit in terms of money. The last three cases involve interest more or less clearly. Time discount, as will be more fully explained, is the basis of interest. The interest may be greater or less than the time discount in the goods, owing to miscalculation on the part of the borrower or to an unforeseen change in the conditions. Men bid for the use of wealth with the intention of repaying it at some future time, and the interest they agree to pay is based on their estimate of the discount of future rents, which they think is involved in their present valuations of the goods. Time discount is involved in goods, however, in numberless cases where there is no contract interest. Even a Robinson Crusoe must recognize in his consumption goods and in his various indirect agents differences in value at different periods of time, of which he must take account. Number 2. Gross interest must be distinguished from net interest. The forms of wealth-yielding incomes are so mutable and are used under such complicated conditions that both in theoretical discussion and in practice much care is needed to distinguish between the yield attributable to the income bearer and that attributable to other wealth or services used in connection with it. That sum paid as interest on a loan contains other elements is recognized constantly in practice. As in the case of contract rent, allowance must be made for repairs and depreciation, so in the case of contract interest, allowance must be made for risk or the average loss occurring in the industry. Money loaned in hazardous ventures must yield a higher rate of interest. Likewise, capital used by the owner in a hazardous venture must frequently earn very high returns, not all logically interest, to offset the losses that are likely to occur. The lender must also, in estimating net interest, count the cost of placing, supervising, and collecting the loan. A pawnbroker lends only small sums and spends much time and effort to keep at interest a moderate capital. $5,000 loaned in sums averaging $10 represents 500 transactions, and yet if placed at 5%, it yields only $250 a year, while therefore the borrower of a small sum estimates the economic interest or anticipated gain in income even higher than the oppressively high contract interest he may be forced to pay. The lender must credit a large part of the gross interest to the labor he expends in carrying on the business. Number 3. The most usual form of short-time loan is that made by a bank or broker to businessmen on security of commercial paper. By commercial paper is meant promissory notes given by customers of the merchants, bills of lading for goods that have been shipped to their customers, and various other evidences of indebtedness that may be offered the banks for discount. When goods have been sold on time, as 30, 60, or 90 days, the seller has a choice between letting the time expire and collecting the bills direct from the customers and discounting the bills for ready money at the bank. According to the conditions and needs of the particular business, either method may be chosen. In most industries, there is a need for larger capital at the seasons when the product is put upon the market. The merchant or manufacturer plans his business in the expectation of an average rate of discount at such times, and if it chances that the discount rates are abnormally high, he has no choice but to go on borrowing and paying the high interest out of the expected profits of his business. This risk of change in the interest rate is one of the many chances he has to run. Number 4, most debts in modern times are outstanding for a term of years and represent the lender's purchase of a claim on the earnings of some productive enterprise. The simplest forms of long-time loans are those made on the security of real estate, which is mortgaged to the lender for the term of the debt. Usually the debtor is obliged to pay the interest either annually or semi-annually, and often, but not always, is permitted to reduce the principal by partial payments. These real estate mortgages rest on the security of the particular mortgaged wealth, and, unlike most short-time loans in bank, are not personal obligations resting on the general credit of the borrower. Most other long-time debts share this character of being non-personal. If payment is defaulted, only the particular wealth can be sold for payment, not the general wealth of the borrower. Corporation bonds issued by railroads and other large stock companies have increased greatly in number in recent years. They yield an income fixed in advance and are secured usually by mortgage on the entire property of the corporation issuing them. The income of some special kinds of preferred stocks is so guaranteed as to make them for investors substantially the same as bonds. Another large class of long-time loans are those made by national, state, and local governments. Tens of billions of dollars of public debt are now outstanding, held by private investors in every walk of life. The contract in the case of each kind of these loans provides for a fixed term after which the borrower must repay or renew, and for a fixed rate on the nominal or par value of the loan. Nearly all the securities, bonds, certificates, evidences of indebtedness are salable at a market rate. It is therefore the income that is fixed, the selling price, or capital value, fluctuating above or below the nominal sum, except just at the moment when it is payable. The long-time loan thus is very similar in its economic character to the old-time rent charge. Number 5, the sale of goods on credit is a mode of lending and involves interest in a disguised form. In some cases, merchants will not sell cheaper for cash than for credit, for fear of offending their main body of credit customers. But this is exceptional, as there are good reasons why such a difference should be made. The credit sale usually involves interest, and often at a very high rate. In many stores, there are two appreciably different prices, one for slow pay, the other for spot cash. If a bill paid at the end of the month is 5% more than the cash price, the difference is equal to 60% per annum for the privilege of postponing payment. Such a rate of interest is paid only by the improvident, but that is a large class ranging from factory workers to college students. The cash discounts allowed by merchants clearly express the time difference. On $50 to $100 of outstanding bills, many perfectly honest persons are paying interest at the rate of 75% per annum. The merchant is forced to make this difference because he must seek not only to earn interest on the capital thus invested, but to recover the cost of bookkeeping and collections, and the risk and loss of unpaid bills. The discounts allowed by manufacturers and wholesale houses measure in the same way the difference between cash and credit sales. Not unusual is a discount of 6% in 10 days, 5% in 30, or 60 net. The borrower allowing his bills to run for 2 months, 6% for 60 days, pays 36% per annum for the use of that money. The difference is so great that it is impossible to carry on in this way a large business against strong competition. Such purchases on credit frequently are made, however, by dealers in small towns. Number 6. Interest is often concealed under other forms which increase the apparent rate. This fact is well shown in the ways by which usury laws fixing the legal rate of interest are evaded. A simple method is for the lender to charge a commission for making the loan, or, if it is a bank, to charge for a pretended cost of exchange to bring the money from some other city. Sometimes the borrower is required to keep larger deposits with the bank than he voluntarily would. Needing $5,000, he is compelled to borrow $10,000 and to pay interest on twice as much as he is permitted to use. Again, the borrower, in periods of unusual demand for money, is forced to make a long loan instead of a short one. When 1 month's loan at 10% will meet his need, he is forced to borrow for 12 months at 6%, during 10 months of which time 4 or 5% is the prevailing rate. In these and other ways, the real rate, or burden of the loan, is made different from that which is expressed. Section 2. The motive for paying interest. Number 1. Interest for loans to obtain consumption goods is paid because they are felt to have greater importance at the moment than an equal amount, either of goods or of money, will have in the future. A sudden stress of misfortune may impart to a thing at the moment far more than its usual value. One standing face to face with starvation cannot be worse off a year hence. Often there is a good ground to hope that if the present misfortune can be relieved, the future better fortune will make it possible to repay a loan with interest. In other cases, the object of a loan of consumption goods is to increase the future earning power of the borrower. When the student borrows money, that represents to him food, clothing, textbooks, tuition, and other expenses incidental to a course in college. The expenditure is intended to increase the effectiveness of the worker. When he borrows, he has little earning power, but with that faith in himself which makes the young American so interesting, he pictures himself, 4 years later, sheepskin in hand, drawing a munificent salary with which he can easily satisfy the most exacting Shylock. Such an expenditure is sometimes called an investment of capital, but it should be called a consumption loan. Nevertheless, in many cases, a loan wisely made. To call this an investment of capital is to confuse man, the end of production, with material means. Sometimes this higher estimate of the present good is unwise, viewed in the light of wider experience. Goods that meet momentary desire make an exaggerated appeal to untrained minds. The child, the spendthrift, the savage cannot properly estimate the relative values of present and future. The improvident sometimes lightly agree to pay an exorbitant interest for an immediate consumption loan, making a ruinous difference between present and future gratifications. Number 2. Interest on indirect agents is paid as a more or less indirect means of securing gratification. This can be clearly seen when durable agents are hired that produce gratification directly. A carriage bought with borrowed capital and used for the pleasure of the borrower is expected to afford a utility greater than that to be gotten by the amount of the interest and any other way. A spade bought with borrowed capital and used to cultivate the owner's garden is expected to add products of greater value than the interest. But how is it in case the agent is used to gratify persons other than the owner? The music teacher who buys a piano on credit expects to increase his earnings by a sum greater than the interest he has to pay. If the addition to his earnings exceeds the interest charge, it is because he has found a use for the borrowed capital greater than that on the basis of which it was capitalized in the market. The amount of interest is secured through the pleasures and service the piano affords to the patrons of the teacher. In the most complex cases of the borrowing and use of indirect agents, there is ultimately the same basis for the interest. Enjoyment afforded by the use of capital in the particular period. To the borrower, what the capital makes possible is an addition to his income as great as or greater than the prevailing interest. Most loans in our society are now of this sort. Money is borrowed to invest in business, to get better machinery or a larger stock. With this capital is secured a better or larger product, and the product finally being sold at a profit. The businessman is at a point where he can satisfy his wants without encroaching on his capital. Logically, therefore, the consumer of the product pays the interest in the price, and the final consumer's enjoyment must be deemed the logical source of the money interest. The borrower's motive for paying interest on these indirect goods evidently is his hope of profit through realizing a greater money rent than he has contracted to pay for their use. Number three, the money market in which short-time loans are made is peculiar in that the money is frequently borrowed to pay debts, not for investment. In beginning the discussion of interest, it is always remarked that it is not money, but capital that is borrowed and loaned. This caution against the superficial errors that so easily beset the popular discussion of interest is much needed, but it is well to note a peculiar case which it is apparently in contradiction to this statement. The usual method by which money is loaned in the great industrial centers is called discount, which is the exchange of a certain sum of money for a note or other credit paper of a larger amount, the interest thus being taken out in advance. Much borrowing in the form of discount is the same purpose as other borrowing: to acquire control of more productive agents, to embark on new enterprises. The peculiarity of the discount money market is that an unusual number of loans are made to meet contracts that have already been made. There is always a great mass of outstanding obligations, and merchants are compelled to renew these loans on penalty of bankruptcy. This market for short-time loans is not connected closely with the general market for loanable capital. When the need is ready money, other concrete capital cannot flow in to meet it. This special money demand, therefore, in time of greater or less stress, may fluctuate rapidly, and the interest rate may be temporarily higher or lower than the rate on long-time loans. This case is similar to that where two markets, as a retail and a wholesale one, exist side by side, but slowly exerting a mutual influence. Number four, in the long time money loan, the money generally is borrowed first merely as a medium of exchange to get control of indirect agents. The borrower of a long time money loan for productive purposes is always seeking to gain by investing the money in wealth that will yield an income larger than the interest he must pay. The borrower therefore invests in the view of the rate of interest, of the market price of the goods in which he plans to invest, and of the probable chances for earning profits in the business. This case, where certain goods whose price is known are approximately selected before the money is borrowed for investment, is the type of loan to be kept most usually in mind in economic discussion. Evidently, the price of these goods, to control which the real object of the loan, is merely the sum of the expected rents they will yield, capitalized at the prevailing rate of time discount. The borrower expects to either make these particular goods earn rents larger than those on the basis of which they have been capitalized, or to transfer them to an economy where goods are capitalized at a higher rate than he is paying. The income yielded by these goods, if the borrower's expectation is fulfilled, is but the difference between present and future rents that has been wrapped up in their capitalization. As time elapses and the rents emerge in wisely chosen investments, the borrower has a surplus large enough to pay the contract interest. It appears, therefore, that the motive of the borrower is to get control of future rents at prices that already involve in their capitalization a rate of discount somewhat greater than the interest he contracts to pay. Number 5. The rate of contract interest on money loans is adjusted at each moment in the money market by the bidding for money loans. This is a true statement only if it is understood in a somewhat superficial sense. No error connected with the interest is, however, more crude than the view that the interest rate is in any broad sense due to the quantity of money. Some loans are made apart from the general market by private agreement between borrower and lender, but in nearly every such case, the rate agreed upon is seen to be closely related to that of the general market to which either borrower or lender can resort if he wishes. The greater number of borrowers and lenders of money have a range of choice in their bargaining. The interest rate in modern developed money markets is that rate which brings to equilibrium the demand for money loans and the money capital available within the period. If the ready loanable money in private hands, in banks, in insurance company reserves, and etc., increases, a lower rate must be offered to borrowers. If the supply decreases, a higher rate will be quoted. In one case, more men borrow; in the other, fewer borrow and more seek to lend. Thus a rate results, but a rate that is closely connected with the larger set of facts, those, indeed, which determine in the long run the rate of capitalization in the community. Number 6. The individual must adjust his business dealings to the market rate of interest. The market rate is fixed by the bidding of individuals, and everyone has something to do with fixing it. In a multitude of minutely small ways, as present and future goods are compared by men, the rate of interest is affected positively or negatively. But for practical purposes, the individual, counting for little in the midst of millions, must look upon the interest rate as beyond his influence. Therefore, while the rate is determined by each to some degree, all that anyone does is to buy or sell present goods, borrow or lend capital, use up or save wealth, according as his own estimate of time value is less or more than the market rate. In fact, the estimates of individuals diverge constantly from the market rate, but are brought into harmony by their actions with reference to both money loans and to the use and valuation of the various forms of wealth. A Robinson Crusoe, working on his island and valuing future goods relatively to present goods higher than before, consumes less, or, valuing them lower, consumes more. The businessman who values indirect agents above the market rate borrows, and if he miscalculates and fails to make them earn the expected rent, he loses. In this experimental way, many other acts are influenced by the prevailing interest rate and in turn affect it, thus aiding to formulate society's estimate of the value of present as compared with future rents. End of chapter 16.